So it's been an extremely hot car market. People have been buying cars like they're going out of style. Interest rates have been low, so people have been borrowing a lot of cash just to get their next dream car. But seriously, there's an elephant in the room that nobody's talking about. And the reality is, at some point, when all of those bonuses from the government that they're handing out, when people run out of their jobs and interest rates are climbing every single day because governments are cranking them up, repossessions of cars are inevitable. Let's get into it now.
Life's too short to drive boring cars.
So car prices have been on the rise for the last couple of years. People have been sitting at home. They're looking for spending some of their cash. And of course, government handouts have been allowing people and enabling people to get their brand new toy car or whatever that is. Maybe that luxury car, that new sports car they always wanted, coupled with the fact that there's been this aggressive chip shortage has essentially driven car prices up. High demand, low availability generally means that people are going to start paying more and more and more to get that new car. But as new car prices have been climbing up over the last year and a half, what we've also seen is the trickle effect. People don't want to wait for that 6 months or 8 months or even a year. Some people want that instant gratification. The government's throwing those checks at you. Maybe I can actually buy that new car, but there's no new cars available, so let's maybe buy that used car. So the used car market, as a result of the spillover, has seen drastic increases in pricing. Almost to the point now where many used cars have matched the price of their brand new counterparts. It just means you don't have to wait. I mean, I still don't understand. Why would anybody on God's green earth want to buy a car with 60,000 kilometers, 3.5 years old, and pay $2,000 less than the brand new counterpart? You just have to wait. So how do you measure this? Well, according to Kelley Blue Book, the average new car price has gone up 13.5%, all the way up to $47,000. And obviously the end result means higher monthly payments. And often a lot of people are still on their same limited budget. That just means they're tightening up the amount of money that they have at the end of the month. And if you look at this chart, you can actually quickly see, surprisingly, repos are actually going down up until 2021, largely in part because of government handouts, surplus cash laying around, people aren't spending it on transportation getting to work and from, low interest rates, and therefore repossessions have been dropping. But don't let this fool you. That's not the true trending. According to Edmunds, approximately 12.5% of people taking a loan out for a new car are spending over $1,000 a month on their new car. What do you think that results in? Sadly, a lot of those people spending $1,000 a month only make about $2,500. That doesn't leave a lot of buffer. Really, that means that there's one inevitability, and that's the repossession. Now, according to the Washington Post, almost 6.3 million Americans are at risk of losing their car. Why is that? Well, what's happening is there's a lot of people starting to default. They can't make their payments, even though unemployment rate is going down, which is a positive marker. The fact of the matter is people are spending far more for a car than it's even worth in a lot of cases. And then we talk about the LTV rate. It's the loan to value ratio. Now, historically, the LTV's ratio is around 80%. In other words, the vehicles historically are worth a little bit more than what your outstanding loan is. When you flip to the opposite side of the spectrum, that generally means you're underwater and you're in a position where you probably paid way more than the typical value of that vehicle, and the amount you owe to the bank is a lot more than the value of the vehicle itself. So if you were to flip it and then try to pay off your loan, you still wouldn't have enough to cover your debt. So now, sadly, we're starting to see vehicles with 120, 130, 150% LTV. Could you imagine buying that new car, driving it for 2 years, 3 years, and all of a sudden realizing, hey, I owe $30,000 on this car, but the market's only saying it's worth 20. That would seriously hurt. And that's happening. That's happening everywhere right now. Because what we're starting to see is on the used car market, we finally tipped over that pendulum, and now the used car markets are starting to dive downwards. Obviously, the wholesale market is starting to tip over. The retail market has leveled off and stabilized and starting to follow suit. So that means it's got nowhere to go but down in terms of your equity, but your loan payment is still just as high as ever. So in case you're probably wondering, how the heck do I know how many repossessions? How do I know the trending of what's going on? Well, there's lots of key indicators. Credit scores are climbing or falling, if you will, and that's a direct, indirect relationship to people defaulting on their loans. Also, if you follow the car dealer Lucky Lopez, he thrives on picking up repossessed vehicles, and he himself is starting to see the trend of far more availability. In other words, he's seeing a lot more opportunities to grab repossessed vehicles for a buy and a flip. As a matter of fact, there's some key markers, and it's showing that you think it's the prime buyers that wouldn't have any impact. In other words, people that typically have great credit scores, they're probably not too impacted by this. But that's actually not true at all. As a matter of fact, the percentage of people with great credit scores have doubled in terms of repossession rates, or default rates, if you will. They're up to about 11% now, which is tragic. Could you imagine 1 in 10 people who actually have credit scores are now flipping their credit scores because of having to give away that brand new car? We also talk about the non-prime buyers, and they're also doubled down from 2 to about 4%, or almost 5%. Are having to lose their cars because they can't afford it. Now, it's not all doom and gloom. If you follow our friends at Cox Automotive over there, then they're basically suggesting that repossession rates are actually down. So if you follow the trend, there was about 1.7 million repossessions in 2019. Then in 2020, it was down to 1.3. And then in 2021, it was all the way down to 1.1 million. Now, that's still a staggering number of people having to give their cars up, especially when they've been making payments and all of a sudden they default. They can't make those payments anymore because maybe food or housing or their kid's backpack to get to school is taking a priority, and they say, well, you know what? I got to give that car back. I just can't afford it. It's still a hefty number. But it's not all on a downward trend. Of course, now what we're starting to see is that shift going the other way again. With government subsidies starting to go away, unemployment dollars drying up. Of course, the interest rates by the Bank of Canada, the US banks, are cranking up their rates every month, every quarter. They're ratcheting up their rates. Now, well, yeah, sure, if you're locked into your existing rate, you're probably okay, but it's not just that ratcheting rate. What's actually happening is the cost of energy is still on the incline. Of course, it costs more for food and groceries. Have you seen the prices? Have you been down to the grocery store lately? You literally have to start rationing these days because there isn't enough money to go around. A lot of people are finding themselves on the fixed budget and not able to even fill a bag of groceries anymore and having to pick and choose. Well, once where they say, hey, I'll take one of those, one of those, one of those. Now they're saying, well, maybe skip that, and okay, we'll take that. That's a sad state of affairs, but that's where we're at. So people are having to ration. Cost of fuel has been on the uprise, although lately there's been a little dip down. The cost of energy in general has been going up. Still prices are higher than they've ever been, and it's taxing people at an alarming rate. Then, of course, there's the other fact. Heating your homes through either electricity, natural gas. The utilities are getting more and more from you, the consumer. And of course, what that means is, again, you have less money for that car payment. And as I say, so far this year, default rates of car loans has been relatively low. And that's primarily because of low unemployment rates, historically high wages, and in some cases, income gains, partially through the government throwouts, and still an elevated level of loan accommodations because people just have a little extra buffer this year. And the rates are still quite low at 2.14%. However, sadly, things are set to change as we roll into the end of the year, and here's why. There seems to be an expectation to rise over 2.3% of default rates, complementary sans 42-year high inflation rate. And of course, we can't forget the other elephant in the room is the growing concerns of the recession that's imminent and likely around the corner. So that would all imply since 21 to now, we're likely going to see almost a 2.5% increase in loan defaults since last year. And of course, while that rate's still relatively low, the trend isn't great. It's worrisome. Even considering people have the high wages this year and of course the government handouts, there's still going to be an increased rate of loan defaults and repossessions. So the idea of this bubble bursting, and it's basically we're right in the midst of it, is both good and bad. So it's good on the sense of if you're a buyer and you're looking for a used car, likely it's going to be in your favor and you're probably going to start getting more opportunities. More dealers are going to likely be open to negotiations, and that's going to work in your favor. Don't forget, best to have some cash in hand because don't be borrowing. Obviously, with interest rates climbing, if you have cash, you can buy that used car shortly. You're going to make out like a bandit. That's a win. But sadly, if you're on the other side of the coin, if you're one of those unfortunate souls that bought overpriced, overvalued car that's really undervalued by the bank's position, then now if you're in a position where you're taxed and you're ready to sell it because maybe you're at a point where you're facing repossession and you say, I just want to get out of this. If you sell your car soon enough and you're in the market to do so, you may be able to unload it at the current high prices. The high prices right now can be your friend if you're selling. If you wait long enough, of course, you'll have a smaller audience. There will be more to choose from for the buyers. Rates are going down for used cars. Now you're possibly going to be even further underwater. If you wait long enough, you're going to really be in a world of hurt. So this is where it becomes a matter of timing if your back's against the wall with the repossessions imminent. But if you're making your payments and you're good to go, no harm, no foul. Just know this, used car prices are going down. Your built-in equity is likely slowly diminishing by maybe 1% every month on month. And that's on top of the natural depreciation that every car seems to face. And how bad is it really? Well, so bad in fact that a lot of companies that are dealing in repossession cars are now buying extra real estate, extra car lots, extra space to put all these cars that they anticipate and are actually starting to see in terms of repossessions. They need the space to put them. There's that many. This does in fact suggest a longer, deeper set recession just imminent. Now, how did we get here? Well, we got here because people were spending like drunken sailors. Sure, interest rates were low, but you knew they had to go up at some point. And of course, the governments are having to add in additional interest rates, and they're lifting the top and the cap to slow and curtail what's going on in the market, to slow down the buying, essentially to slow down inflation so you can buy that bag of carrots at the grocery store. But now because banks were giving loans to every Tom, Dick, and Harry without any level of scrutiny, and even a buyer that says, I make $2,500 and I can take on a $2,000 a month bank loan, says, I have enough to cover that. Clearly there's been lots of bad decisions, lots of people overreaching, banks not scrutinizing, lenders not caring, they're just trying to sell a car. Now here we are, backs against the wall. So unfortunately, if you're one of those souls that are facing this dilemma, just remember there's a couple of options. One being just ride it out, work harder, do those things to try to save your pennies and put it down and try to get that loan paid off as quickly as possible. The other thing is if you're about to embark on a car payment, maybe you're going to buy a new car, the best thing I can suggest is to avoid repossessions. Get yourself in a place where you're financially stable. You're not overreaching. Very small car payment, very short lending term, and then you're not likely to be up against the wall with the banks chasing you around. Because remember, the repo man's coming after you. In 90 days, he's going to be up your schwanz looking for that car if you haven't made your payments. So bottom line, repossession rates are on the climb. And with all of that said, be sure to click right there. You're going to love that video. It's going to give you the basis of what's happening right now and why I believe that the car market bubble has finally burst. Hope to see each and every one of you. Catch you next time. Bye-bye.